ultimately, gold and silver are going higher. And that's why you're seeing big money accumulate it. And that's why I think you're seeing the sophisticated traders push the price higher and higher and higher. They are front running the inevitability of the corner that the United States Federal Reserve is painted itself into. The inordinately large deliveries by central banks and by large players as the price is going down. When you see China buy more silver than at any time in the history of their country over the first quarter and huge amounts the second quarter as the price has been going down, this is the second largest producer of silver in the world. And in essence, they're thanking the market for lower prices. From a technical standpoint, it's fairly significant. We have seen a falling wedge pattern, as it's called, and a falling wedge pattern gets more narrow as it gets down towards the bottom. And if the move breaks either way, it has potential to be fairly significant. The fact that it broke out through a falling wedge pattern from a technical standpoint is very bullish. But look, the public doesn't really, they have the right to be cynical in this kind of analysis. You look around and you see, well, it's not hard to get silver in the industry. So why is everyone saying that, what's the deal with silver? Why isn't it priced higher? Why can you still get it? First of all, this is when we're talking about the setup that you're hearing from these folks. We're talking about there's the rising, the falling wedge pattern, and as it broke through, that's a big move right there. That's significant from a technical standpoint. But look, the bottom line is that forever the price has been controlled in the West under the assumption that no one stands for delivery.
The biggest signal in silver right now might be hiding in a contradiction. Prices fell even as powerful buyers kept scooping up metal. Schectman's point is that China's unusually aggressive buying during a period of silver weakness suggests sophisticated players saw the lower prices as opportunity rather than warning. That distinction matters since technical breakouts don't mean much without real demand underneath them. The bigger question for investors is whether Western pricing still tracks physical reality at all, or whether it's become mostly paper market noise.
It's being challenged. And the COMEX is losing significance. Price discovery is moving eastward. At the highest level, getting industrial-sized bars in large quantities is becoming more challenging without spooking the market. And I think that we will see prices continue to move higher. That's not why you buy it. And I don't know how many times I've said that. You don't buy silver to become wealthy. You buy it because it is wealth. It is a critical mineral. It is becoming more and more obvious to the very, very sophisticated traders that that gold and silver are far more important and far more relevant than the price would dictate. And I did an interview today with a man named Paul Barron, who I'm very good friends with. Paul, I'm very fond of him. He's a very smart guy, but his focus is largely in the digital space and focusing a lot on how we are now beginning to see fintech companies, big ones, get into tokenized silver. Now, what I really, not that I want to focus on tokenization, but simply to say we would then potentially be unlocking a massive wave of buyers who haven't looked at gold and silver. And he said to me something very interesting. He said, Andy, I didn't look at gold and silver as money. And I wouldn't have ever believed it until the last several months when I've been researching this trend of tokenized gold and silver. And he says, I'll be damned. It's money.
Silver's pricing power might already be shifting before most investors have caught on. Schectman argues that growing difficulty sourcing large industrial bars points to a deeper move away from Western paper pricing and toward physical price discovery happening elsewhere. The overlooked catalyst here is tokenization. Digital finance could open the door to an entirely new class of buyers without requiring any traditional expertise in metals. For anyone thinking about wealth preservation, that means today's accessible silver price might not reflect the liquidity conditions of tomorrow.
And the similarities between the thought process between the crypto community and the physical metals community is a lot closer than one would think. And so what I'm beginning to see is not only do we see institutional demand increasing at every level, not only do we see smart, very sophisticated central bank buyers buying it as the price has been going down and whoever's been standing for delivery here, regardless of how much is left COMEX, But I have a feeling that we are getting to the point very quickly where you are going to see a wave of buying from the digital sphere who is now really keen all of a sudden on tokenization of gold and silver and becoming aware, finally listening to the argument instead of being divisive of the two arguments and of the two industries. They understand it's actually quite complementary. So that, along with a further awakening at some point, probably unfortunately via some sort of an event that wakes up the mainstream, I would suspect this next time, not only will you have the push of the industrials and the institutional investors and the central banks, but a wave of the public buying in multiple fronts, physical and tokenized metal. I think the wave is just beginning on that front. So, look, what you said is true. What all of the people you cited have said is true. It hasn't manifested itself in much, much higher prices, but that doesn't mean it's not true. It just means that price has been controlled in the West. And I really do believe that that is something that is ultimately, not just in gold and silver, but all of the commodities, is a privilege that is going by the way of the dodo bird here for the West. And you're going to see more and more and more price setting and price settlement leave the West and move towards other arenas, whether it be the East or the South or even fintech 24/7 settlement. You had JP Morgan just come out. It was either JP Morgan or actually Jamie Dimon, and warned of massive food shortages and, like very bad, like, starvation level.
Famine.
Yeah, famine. Thank you. As a result of this fertilizer problem, where a third of all the fertilizer comes from that area. But a lot of this problem coincided with the planting season, and so starting this season, they expect crops to be far less than normal. And then when you look at the fact that energy, he showed an interesting chart in that video where energy and food prices, move lockstep, first energy and then food. When you talk about the bleed down of the Strategic Petroleum Reserve to the lowest level in over 40 years, it's very frightening, and it's masked the real reality of just how extreme this energy problem could be. He talked about the shortages of gasoline in the 70s. My father told me back in Minneapolis, there was a time when the gas stations during the oil embargo would take a silver dime. This is when silver was approaching $50 for a gallon of gas. That would have been a good deal for the gas station back then. But we're getting to the point where, if what Mike is saying is true, the second half of this year, because there's typically a 6-month lag in these types of movements, especially when you're masking it. But this is really the setup for what is known as the Cantillon effect, where the wealthy get wealthier because they have a disproportionate benefit of being able to buy assets closest to the money supply. They buy assets that go up in an environment that will be inflationary. And when we talk about what happened with Japan recently, it's framed as benevolence, helping out our friends, but really what it is begging them not to sell treasuries to blow up our bond market and the global carry trade, or the yen carry trade. If Japan would have done what is logical, which is find price discovery, sell the 150 billion or 80 billion of the 1+ trillion in treasuries that they possess, which would have been logical, it would have manifested itself in much higher interest rates. And by them, in essence, convincing them to instead pledge the treasuries as collateral and take a loan out from a dollar window that wasn't designed for this, but to do it in that respect, and to have the Treasury Secretary lobby in public for the Federal Reserve to increase this window, and kind of blurring the line between the Treasury and the Fed. In essence, what it is yield curve control masked as benevolence, because they cannot allow the rates to go high, everything blows up. And when you cap rates to the way that they are going to do, and the world is witnessing this right now, and is beginning to, the smart money is front running gold and silver right now because they see we're trapped. It's an old married couple who started painting the floor of the house at opposite ends and have ended up meeting in the corner. There is nowhere to go. If they allow rates to rise, everything implodes, if they do what they've always done. And already there are stories that Warsh isn't the hawk that he pretended to be. And if they indeed do what all governments have chosen to do, which is to inflate instead of do austerity, normalize, all roads lead to the same place. But when you cap the yields, it manifests itself in much higher price inflation. So you put it all together, you have much higher price inflation we haven't even begun to see yet, both through rising yields and masking of the oil problem, and higher costs in shipping and in manufacturing and in fertilizer. Not only leads to food problems, it leads to much higher prices for all of the necessities that we need. And this is where you'll get the arguments of a much more widening of the classes, where the rich buy assets in an inflationary environment that goes straight up, and the poor and middle class, which gets eviscerated, is having just a terrible time just trying to put food on the table and drive to and from work, get insurance, pay tuition, whatever it may be. Those costs continue to move higher, and I expect they will. Ultimately, gold and silver are going higher, and that's why you're seeing big money accumulate it, and that's why I think you're seeing the sophisticated traders push the price higher and higher and higher. They are front-running the inevitability of the corner that the United States Federal Reserve is painted itself into.
Gold's appeal grows strongest precisely when policymakers leave investors without any painless way out. Schectman's argument is that sophisticated money is positioning ahead of constrained monetary policy rather than waiting around for inflation to become obvious. That same pressure is already showing up in businesses struggling to absorb higher operating costs. For investors, that means financial stress can work its way upward, starting with everyday expenses and eventually spreading into asset markets.
With the inordinately strong dollar as a result of being the world reserve currency, those third world nations that are indebted have a much harder time as their currency depreciates against the dollar, not only through Triffin's dilemma, but just through natural market forces. They're double squeezed. They have to get dollars to buy oil, which, in an environment where the dollar keeps going stronger, it's much, much harder on these countries. And yeah, I think it's sad. What he was saying was that the West will buy up all of the fertilizer that is out there because they have the ability and the wherewithal to pay more. And that's what will probably happen. And so you'll have, I guess, rolling starvation. It's just even disgusting to even say that. But yeah, these are the second and third effects of blowing up the infrastructure, which is, like he was saying, even if, whether you're talking the Ukraine, which is the breadbasket of Europe, it is one of the largest producers of grain in the world, or you're talking the facilities in Qatar, Oman, or any of the, UAE, Saudi Arabia, even if everyone shook hands and hugged today, you're talking 2-3 years to get everything back up and running again, just from the damage that has already been done. We haven't experienced the effects yet. They have been masked. And the scary part is, in order to maintain price stability globally, we have lent out a massive amount of our strategic petroleum reserve, not just to the United States, to China and other countries, to ease the burden of this conflict. So, it's from a standpoint of preparedness, your roots, it makes you wonder, at what point does it become every country for themselves? Now, fortunately, we have the ability to be, energy self-sufficient, but again, is our infrastructure ready to do that? I don't know. I'm not an expert there, but I can tell you globally that interest rates are rising across the board, and there's going to be a reckoning when the debt markets, and if you try and hold down those interest rates to string it out a little longer and keep kicking the can down, the only way that pressure, and you look at M2, it's going through the roof. M2 is a measure of inflation, not the stupid CPI, which doesn't measure most of where all this money is going into, and those are assets.